This is very, very important. Huge.
I always call it massive. Sometimes they say huge.
This is huge, bro.
So the first thing that we need to analyze is the accounting equation. It's a very simple equation, and I know, gang, that I told you guys accounting is not really math-based. But we do have an equation that sets forth our whole conceptual framework of accounting. So the accounting equation is assets equals liabilities plus stockholders' equity. And it's quite simple of an equation. And like all equations, both sides have to equal. For example, let's pretend that the tattoo shop that I notoriously owned in my previous videos about business organizations now became a corporation. Well, now that it's a corporation, let's assume that at this particular point in time, the value of my assets in this tattoo shop is, let's say, I don't know, 40 bucks. Let's assume that the liabilities that I have in this particular tattoo shop is $10. Well, if we utilize the accounting equation, we can easily assess what's the value of the shareholders' equity. Based on our accounting equation, we know that if our assets are $40 and our liabilities are $10, our stockholders' equity obviously has to be 30 bucks. So let's take some time out to explore assets. Assets are any type of economic resources that provide a future benefit. Out of that definition, the things I want you to focus in on are the words economic resources and future benefits. And so, assets is a category, think of a family, of separate individual accounts. So, list of assets, cash, land is an asset as well, a future benefit in land. Perhaps we need a building, right? That's a future benefit in that, right? Equipment functions as some type of future benefit, right? What about supplies? Supplies would be an asset as well. How about furniture? Inventory that we sell for to hopefully receive a profit, right? Well, that's considered an asset as well. So, we have numerous amounts of different types of asset accounts that a business can purchase in order for them to help generate some type of cash or some income. So now that we narrow down what are assets, let's move on to liabilities. Liabilities are any type of economic obligations that are owed to outside individuals, outside of the company. But guess what? I'm going to supply you with something even easier to remember.
Hit me with it. Just give it to me straight.
Liabilities are just things that we owe. Most of the time, the liability is going to be that you owe cash, all right? So, with that being said, I like to provide you with some liability accounts. Accounts payable, notes payable, salaries payable, mortgage payable, utilities payable. Now, stop. I'm willing to bet that brain is firing some serious neurons and we could definitely detect some common occurrences going on with those name titles, can't we?
Oh, come on. Think.
So what does that mean? 95% of the time, your particular liability account that you owe on, last name will be a payable. So if it's a payable, it's a liability. Oh boy, so here when it gets real. Stockholders' equity. So this is the bread and butter of the accounting equation, in my humble opinion. So with that being said, let's take it to the board. Okay, gang, we're gonna rock and roll with stockholders' equity. Now, stockholders' equity is one of the most complicated parts of the accounting equation. So I'm gonna make a separate detailed video explaining stockholders' equity. But for right now, I'm gonna give you the quick and dirty version so we could just get to the point to keep this video short. So basically, stockholders' equity, from a equational standpoint, is simply your assets minus your liabilities in the company. So what does that truly mean? It means that the shareholders' equity, what they truly own when they invest in the company, is the remaining assets after all the liabilities have been satisfied or paid off. And so from that perspective, stockholders' equity is broken down into two categories. The first category is called paid-in capital, and the second part of stockholders' equity is called retained earnings. So let's talk about paid-in capital. First and foremost, paid-in capital is a title, gang. It's just a title, all right? So what does this title represent? It represents the funds that are generated from shareholders. How do companies generate funds from shareholders? By issuing stock to them. Anytime the company issues stock to shareholders, they receive cash. So that's how the company generates funds. So with that being said, the paid-in capital accounts, the stockholders' equity accounts that are related to paid-in capital are common stock, anytime we issue in common stock to shareholders, or preferred stock. We're going to talk about the difference of those much later, gang. But for right now, I just want you to zero in on the two types of accounts. Now, there are more paid-in capital accounts, but we're going to just focus on these two right now, common stock or preferred. Therefore, anytime the company issues common stock or issues preferred, it increases paid-in capital, thus increasing stockholders' equity. So what is the second part of stockholders' equity? Retained earnings. Now, like common stock and preferred stock, retained earnings is an account. It is a special account. And so by definition, if you look at the key words, retain means to keep, and earnings is just another form of income. So retained earnings is simply the income that the company decides to keep for them to be able to help operate or grow the business. And so with that being said, there are certain types of accounts that affect retained earnings that are not actually stockholders' equity accounts. Okay, so let's talk about the different things that affect retained earnings. But first and foremost, we need to understand how to measure income, because by definition, retained earnings is income. Income is simply measured by taking revenues earned minus expenses incurred for the period. And so if you have more revenues for the period than you do expenses, you have a net income. Net income affects retained earnings positively, which means it's going to add or increase retained earnings. If you have a net loss for the period simply says that you have more expenses for the period than you do revenues. If your expenses are higher than your revenues, you have a net loss. And net losses happen to decrease retained earnings. Now we're going to talk about revenues and expenses in the other video, gang, so make sure you watch that, but this is the quick and dirty version. And last but not least, retained earnings is affected by dividends. Now what are dividends? Dividends by definition is a distribution of income to the shareholders. So anytime a company generates some sort of income and they decide to give it to the shareholders, they give it to them in the form of dividends. And because dividends is a piece of the income generated, it affects retained earnings. So think about it, gang. If we're giving dividends to the shareholders and it affects retained earnings, how would it affect retained earnings? Obviously, it would affect retained earnings negatively. So anytime we give dividends, it decreases retained earnings. So what am I saying? Retained earnings is affected by net income, net loss, and dividends. And so that was the quick and dirty version about stockholders' equity, but I really would like for you guys to buckle down on Anchor and watch the other video that explains in much detail of stockholders' equity. Thanks for tuning in to Accounting is a Joke, and I hope that everything made sense for you guys. And if that light bulb is clicking, don't forget to like, add, and subscribe to the channel for more ways to chase the bag with this accounting information. See you soon.